Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report right before Christmas. I appreciate all of you joining us on this, what I'm sure is a busy weekend for all of you, getting ready for Christmas and continuing on with the holiday season. We are going to mostly recap again what happened about a week and a half ago with the Fed pivot and the market reaction on the back end of that, and try to really look ahead to project what 2024 is going to look like, because there are still a lot of question marks whether the markets are going to continue trending higher like they have for most of the year, whether the Fed is going to cut rates, and what that could look like carried over to a number of other markets. We are kicking off the show with Jesse Felder, founder and editor of the Felder Report. Now, Jesse, let's start off with your comments on this Fed pivot. Yeah, the Fed didn't cut rates, but boy, oh boy, Jerome Powell's press conference, as we've talked about for the last week and a half, he came out about as dovish as he could have, and really, it seemed like tried to lock in the fact that rate cuts would happen next year, whether the economy drops out of bed or not, as long as data keeps moving in what the Fed is predicting, which is lower inflation and still a gradual slowdown in the economy. Jesse, what does this carry over for next year? Do you think that, A, we're going to be seeing rate cuts, and quite frankly, this pivot party, could it continue?
I mean, it's a great question. I think we first have to try and understand where this pivot was coming from. And to me, the greatest evidence that there was indeed a pivot came from Nick Timarios, who's, the Wall Street Journal reporter who covers the Fed, and who's the Fed has leaked information to him over the years. So he's probably the single greatest indicator of what the Fed intends to do. Nick Timarios asked Jay Powell about the dramatic loosening in financial conditions that we've seen over the last 6 weeks, which is one of the most rapid loosening of financial conditions we've ever seen. I think everybody, economists, market strategists, expected Jay Powell to push back and say markets have gotten ahead of themselves. It's too early to be talking about rate cuts, and basically just say the same thing that he's been saying for well over a year now, which is inflation is a problem, and we're focused squarely on making sure we bring inflation sustainably back down to target. The fact that he didn't push back, he said, markets are going to do what they're going to do, and he given that opportunity to push back against the loosening of financial conditions, and the fact that he declined to push back was a very clear sign that they're no longer focused on the inflation side of the mandate, or at least solely on the inflation side. They're becoming much more concerned with the employment side of the mandate. Now, what inspired such a rapid flip-flop? Because less than 2 weeks before that, he was, publicly still saying that, they're focused on inflation. It's too early to talk about rate cuts. So something in that 2-week period happened, and he changed his tune dramatically in a short period of time. So I think there's two potential things that I see. One is either the Fed sees rapid deterioration in the economy, they don't want to be late in addressing, or there's just, you could use the term fiscal dominance, which is something I've kind of been talking about for years now, which is the fact that the monetary policy discretion is just no longer there for the central bank. It's far more important to meet the needs of the Treasury than it is to do the right thing for inflation or unemployment or whatever. Really what that means is there's so much federal debt out there that needs to refinance over the next, however many years, that if it were all to be refinanced at 5% plus, could cause big problems, could cause a debt crisis. And so the needs of the Treasury are such that interest rates have to come down because they just cannot be refinanced otherwise. One of those potential scenarios or things is probably what inspired the flip-flop. And I think it could be a combination of both. That the economy is slowing significantly, and the needs of the Treasury are becoming a very serious, you could call it the Fed's third mandate. Is, you need to help fund the government.
Yeah, Jesse, let's dig into this a little bit more, because I'm sure from Janet Yellen's position, that's what she cares about the most, is making sure we can fund the government, and the huge amounts of debt, if it's rolling over at 4.5% to 5% on the rate factor, is going to chew up so much of the money coming in just in debt servicing. But, you bring it down to the smaller businesses, and you had mentioned off mic some of the NFIB reporting. But if you just think about it, a lot of businesses that are small businesses borrow money to cover payroll, to cover sustaining capital for their business, if they're going to do improvements or build onto their business. And they've lived in a world for a dozen years where they could borrow at near zero rates, at 0, 1, 2%. If they start seeing double-digit loans that they need to do, that could really put a hurt locker on the small business sector. Do you think that's something that the Fed could be looking forward and saying, hey, this higher for longer may start crippling businesses we hadn't even considered?
Absolutely. I mean, you look at the trend in bankruptcies, corporate bankruptcies, and a lot of those are just small businesses. And bankruptcies are soaring. Look at credit card delinquencies, look at the trends in credit. And I think to be, really believe in a soft landing, you have to think those trends are going, which are all rising, right? We're seeing credit card delinquencies, auto delinquencies, all these things rising significantly, that these trends are literally going to just stop. Right there. I mean, that's what you hear from kind of the economic bulls right now, is that, well, these things are just normalizing, right? All these default rates got so low because, we printed money and we put it in people's pockets. And so now we're just getting back to more normal levels. But I think it's really important to look at the trend, right? These things are all trending towards higher defaults and delinquencies. And I think if you just extrapolate that trend out and say, well, if these things continue, we're going to see higher, defaults and delinquencies than we did during the Great Recession. And, that's a big deal. So I think, that could be part of what's going on as the Fed looks at, okay, it's not just the federal government's having a problem. All of these corporations and individuals, right? I mean, look at credit card, interest rates on credit cards and auto loans and mortgages and, and all these things. And so, if you believe that this trend is going to continue in delinquencies, we're going to get to a point where, you cross that line into recession. And, that could certainly be something Jay Powell's looking at closely.
Oh, absolutely, right? And that could be very much a reason why they want to start cutting rates even, let's say, before a full-on recession hits, however they want to define it. But Jesse, can you dive into their dot plots as well as the economic forecast changes? Because it really seems like the Fed wants to follow inflation lower. And right now, if you look at some of the inflation metrics that the Fed looks at, where the Fed's funds rate is, it's almost 200 basis points higher than some of that inflation data. Seems like the Fed really is expecting, first of all, inflation to continue to trickle down over the next 2 to 3 years to get down to that 2% level. And at that point, they want the Fed's funds rate about 50 basis points higher there. Where are the issues that you see, either in the dot plots, which are expecting about 3 rate cuts next year, or the economic forecast that the Fed provided us heading 2 to 3 years out?
I mean, I don't really pay any attention to the dot plots personally. They're always wrong, right? It's good to know kind of what the Fed is thinking, about those things, but they're always wrong, right? I mean, you go back to, 2020, whatever, 2021, and they believed, Fed funds rate was going to peak at 2% or something silly. And, we're 5+ now. So to think that they know where the Fed funds rate is going to be a year from now doesn't make any sense to me. I think the biggest thing to pay attention to right now is the fact that Jay Powell did not push back against that loosening of financial conditions. Really opens the door for inflation to be a problem next year, to bottom out now and start reaccelerating. And the thing that we were talking about before we went on the air here is that you look at things like median CPI tracked by the Cleveland Fed, you look at things like sticky price CPI, and even super core inflation, which is the measure the Fed has pointed everybody to keep a close eye on. And if you just look at the 3-month annualized rates of these things, they're reaccelerating to the upside. So inflation has been pushed down by, right? We've had energy prices come way down, supply chains reopen, and this is all great. So goods inflation has come way down. But services inflation and wages are still elevated. And so the fact that the Fed is letting its foot off of the gas right now in terms of the tightening of financial conditions really opens the door to a reacceleration of the inflation problem at some point in the future. And I think you can already see it in housing activity. We've had interest rates come down on mortgages, from 8.5 or something down, well into the low sevens, I think. And you see housing starts pick up dramatically, in the news this week. And that suggests to me that there is resilience in the economy, and that it opens the door to a reacceleration to inflation on the upside. I think Raghuram Rajan, who is former central banker for India and warned the Fed about pre-financial crisis at Jackson Hole. I mean, he came out and said recently that before you'd even want to consider pausing rate hikes, you'd need to see wages come down much more significantly, a much more loosening of the labor market. And we're not seeing that. And so I think we might look back on this time for the Fed like we look back at the transitory period where the Fed was saying we don't need to raise rates because this inflation spike is transitory. Well, it turned out that was a very bad misjudgment, one of the worst misjudgments in Fed history. And this could prove to be another similar misjudgment of the underlying inflation pressures.
Yeah, Jesse, it's really interesting how inflation was the prime target that everybody watched every month for the CPI readings, or we would look at the PCE deflator information that the Fed uses, and everybody was trying to parse what Fed policy would be. But they really made a point, not just Powell, but also Williams came out and reiterated this, and even Bostic reiterated this at the end of last week, that it's really about the dual mandate. You'd mentioned that earlier. So, as far as the inflation side, it seems like everybody thought they're going to definitely want to keep it at 2% or below 2% for a period of time before they'd even consider cutting rates. And now they're saying, hey, look, we need to look at the employment situation. And Powell even said, you're getting back to the point where both mandates are important. We'll be very much keeping that in mind as we go forward, kind of highlighting to the market that he wants to look at unemployment. He wants to look at the labor markets. He wants to look at the business side of things. Is there any other data you see on that side of the front, on the labor and jobs market side, that has you encouraged or discouraged?
Regarding inflation, I mean, I think, to me, I'm looking at the longer term trends. I think they're, and I've said this for a couple of years now, everybody needs to go read, The Great Demographic Reversal by Charles Goodhart and his co-author. His name is escaping me right now. But he talks about the demographic shifts that we're seeing right now that are a structural inflationary force, right? It's a shrinking of the workforce relative to the overall population. And it's this dynamic that is allowing for labor unions to have much greater control. We're seeing the greatest labor unrest that we've seen in half a century, right? You're seeing UPS workers get massive raises, auto workers, massive raises. I mean, across the board, airline pilots. And to me, this is a very clear sign that we're in a different environment than we've seen over the past 10, 15 years, where labor was really struggled and capital benefited, right? All of these companies were able to ship jobs overseas, to China and production and everything. And that lowered their costs and really enhanced capital's negotiating power with labor. Say, okay, you guys want more money, you're fired. Now that's changing where companies cannot shift jobs over to China anymore. There's too much geopolitical risk, and the cost benefit is not really there anymore in the way that it was prior. So we're seeing all this labor unrest, and to me, that's a very clear sign that we're dealing with a very different type of economy and inflation situation than we have seen over the last 10, 15 years. So I think that's why people like Rajan, are saying that we need to see wage inflation come down and a much loosening in labor conditions to have any confidence that inflation is going to come back down to the Fed's target. And there's literally no evidence of that. I mean, right, we're seeing job openings fall, but they're still above any prior highs. So there really aren't any signs that I can see that would justify the Fed backing off on the inflation side of the mandate as early as they are now. I think it's really important to keep an eye on that wages side of things, because that's where, this inflation spike will potentially evolve into a wage price spiral, which would be the thing that really the Fed should have been guarding against and still be guarding against today.
So, Jesse, let's carry this over to the markets then. Look, the markets had a pivot party. They've been having a pivot party for the last almost 2 months. Some strong moves in a wide range of sectors, even with small caps playing a little bit of catch up. Metals did well. Commodities did well. Again, it was almost across the board a flat-out pivot party. What's sustainable? What could continue through next year then?
Well, I think that if you were a precious metals bull, that Powell press conference would be the most bullish thing you could ever hope for, that the Fed is going to back off the inflation side of the mandate. To me, it was a huge green light for anybody who's interested at all in hard assets or anything like that, because it says, we're going to let our guard down in terms of inflation, or we're going to err on the side of letting inflation remain above target. Now, if that's kind of how things play out and inflation doesn't come back to target, and that will make it really, really difficult for the Fed to cut rates in any meaningful way. And I think that's probably supportive of that higher for longer case. So I think you have to either be bullish on the economy. In that case, you're not going to get any rate cuts. Or if you're bearish on the economy, then rate cuts are going to come, but they're going to come because of a significant deterioration in the economy. That's not bullish for equities, right? Equities are discounting serious earnings growth for 2024. If you don't get that earnings growth, you have a big problem with valuations. And so I think that this pivot, while markets have interpreted as being very bullish for financial assets, I just don't see it. I don't think this is bullish for stocks or bonds, because it likely means inflation is going to stay high. I think maybe the most likely outcome for next year is some type of a stagflationary environment where the economy continues to weaken, maybe not into recession, but inflation also stays high. And that doesn't really allow the Fed to really do much to support the economy. Now, stagflation is the polar opposite of a soft landing. So, if markets are priced for a soft landing, and I think they are, there could be real disappointment there.
Well, Jesse, just to that point, I mean, several people brought this up even over the weekend in missives, that it seems like a disconnect that the market is missing, that if they're excited about, if there's a pivot party because they're going to be cutting rates next year, they seem to be missing the point that if they're cutting rates next year, something else is going on in the economy that wouldn't be positive. And if you see an uptick in inflation and they can't really cut as much, that's also maybe a reason to have not partied so hard. So I mused over the weekend that could there be a hangover after this? And you had mentioned in a recent piece you put out that the market applauds the pivot party, that maybe it's premature for the markets to have rallied so high, because any way you slice it, either next year if it's stagflationary and you see oil higher and commodities higher, that's not good for business. Or if the Fed can't cut because inflation ticks up, that's not really good either. And maybe they partied too hard. So what do you make of the extremity of this move, and could it have gotten ahead of itself here?
Oh, absolutely. I think we're at a very important inflection point for the stock market. I'll just give you 2 data points, things that I track pretty closely. One is the small speculators' position in S&P 500 futures. They recently put on their biggest net long position in history. The prior record was in November of 2021, just before the market peaked and rolled over into the bear market of 2022. So these small speculators are usually on the wrong side of the market. I mean, very regularly on the wrong side, and they're record long right now. Flip on the other side of that, another thing I watch very, very closely is insider buying and selling. The corporate executives and directors, what are they doing in their own shares? And right now, we have over the last 12 months, the smallest amount of buying I've ever seen on record. So insiders have zero interest in buying stock, and small speculators, who are, usually very good contrarian indicator, are buying like there's no tomorrow. And so to me, it's a very, very, from a contrarian standpoint, it's just screaming, it's time to be bearish.
Jesse, is there any data, any market moves that would change your mind, that would change this kind of generally more economic bearish, more inflation spiking, and also more markets have run their course higher and are too high right now? Anything that would change your outlook early on next year?
Here's what I think the Fed should do. is they should stay tough on the inflation side of the mandate. And now I just don't think they can afford to, because unlike, I think debt to GDP on Paul Volcker's time was less than, 75% lower than it is today. So Jay Powell simply cannot be the second coming of Paul Volcker, even though that may be what we need in order to bring inflation back down. So I think we are in a new environment of, and we've talked about this for, a couple of years now, at least. We're in a new commodity super cycle, and it's going to be driven by this higher inflation cycle that is a structural, systemic issue. So I think if the Fed really wanted to address this, Jay Powell would have to make it very clear to Congress that the fiscal house needs to, get their house in order and do the things to set the stage. Yeah, you have to take short-term pain for the long-term benefit of the economy. Now, the fact that we're not willing to do that right now, Congress is not, and the Fed is not, Treasury is not, nobody is, right? I mean, Janet Yellen is focusing on T-bills right now, and she could have, like Stan Druckenmiller said a month or two ago, the Fed had a huge opportunity to sell a bunch of long-term bonds at ultra-low interest rates, and they passed on that opportunity, right? Nobody wants to do the right thing for the long-term health of the economy. Now, if Congress were to, get its act together and say, we're going to really address the budget deficit, and the Fed is going to say, okay, you do that, and we'll be able to handle our side of the inflation side of the mandate, then I think you'd set the stage for a really beautiful long-term picture for the economy and for financial assets. But until that happens, it's really difficult, I think, to be bullish on financial assets. And I think from a defensive standpoint, you have to focus on hard assets.
Well, Jesse, just to that point on the hard assets, and there's a sector I'd love to get your thoughts on. I know a lot of our listeners follow along with that, and you do as well, and that's the energy space. Oil prices tie into really every part of the economy. They're a factor in freight and shipping, but they're obviously a huge factor in inflation. They affect consumers, they affect businesses, and it seems to have bottomed and had a rally here on this news as well. There's a lot of dynamics in the energy space. How are you looking at the energy sector?
I'm very bullish. I mentioned insiders a minute ago, and I just keep seeing insider buying in select companies in this space, which tells me, and it's really the only equity space where I see consistent insider buying. And that just tells me that they have a very strong belief in the long-term prospects for these businesses over the next several years, and they believe the valuations are very good. I think what we've seen in the oil market is the markets trying to price in a recession, and I think that's where oil has gotten. The oil price has priced in a recession. Now, so if you don't get a recession, then the oil price could just rebound really strongly about that. But if you do get one, then it's kind of already in the price. So I see a margin of safety in the energy sector today that I don't really see anywhere else. Part of that pricing in a recession is the fact that, the Commitment of Traders report shows, I think it's the managed money and the non-commercial speculator side of that ledger are massively net short these commodities futures. So I saw somebody on Twitter suggest that traders in oil futures are betting on another, essentially like great financial crisis, another Lehman moment for the economy. That's the only way they're going to profit, being so heavily short the oil price today. Now, if you don't get that, right, if you don't get a financial Armageddon, then that means, oil price is oversold and due for a rebound. Just the short covering, like I said, if we don't get a recession, just the short covering and the sustained demand in oil is going to make for much higher prices. And so I think there are a number of things working in favor of energy today. Sentiment and fundamentals are just two of those.
All right, Jesse. Hey, thank you very much for your time on this weekend show. Thank you for your time throughout this year. I hope you have a very Merry Christmas, Happy Holidays, and a Happy New Year. Next year undoubtedly will be a very interesting one as we do again kind of what we did this year, wonder when the Fed is going to start cutting rates and how the economy and how the markets are going to react to it all. But boy, oh boy, there's a lot of optimism, at least in a number of investors in a number of different sectors heading into the new year, just thanks to this last couple month run. Jesse, again, thank you very much for your time. I hope you have a great rest of your weekend and a very happy new year.
Thanks, guys. Happy holidays to you.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we are going to continue to look more broadly at these markets with a bit more of a focus on some of the charts and individual sectors, as we are now chatting with Dana Lyons, fund manager based out of Chicago, also editor of the Lyons Share Pro website. Dana, let's start off with the broad averages here. The Dow recently moved to all-time highs. The S&P is still relatively close to all-time highs. But look, we really hear a discrepancy between some of the bears saying these markets have gone too fast. They still don't like the outlook for 2024 in terms of a recession. And they think that, quite frankly, maybe this is kind of just a blow-off top for markets. But there's some generalists that we have on, you being one that look more at the charts and have, at least some of these other guys said, these markets look pretty strong right here. Look, there's no denying that the S&P has been strong. It was 6 days in a row that it was hugging that upper Bollinger Band, almost straight up through all of December and even the last maybe month and a half. Dana, what are you seeing in this market? Is this truly a strong market for the broad averages?
Yeah, thanks, Corey. As you know, as we've talked about for years, we have, quantitative models that help us decipher exactly the questions you're asking. Is this a strong market? Is this a market that we want to be substantially long, or do we want to be substantially out or even short? Is this a rally that we really believe in? And the data that we track that we think is important suggests that there are legs to this rally, that it is still firm. The data that we look at is still supportive of a strong intermediate term environment for stocks, for not just the large caps and the techs, which have been leading for some time, but we've seen a lot of improvement in the broader market, in the amount of participation across the market, all cap sizes, small caps, mid caps. We've seen a lot of improvement in terms of the internals, at least since, over the last month or so. And that's certainly, as opposed to the start of the rally when it was mostly short covering and the large caps leading the way. This increase in participation is exactly what we want to see in order to give us more confidence that there is a durable or persistent nature to this rally. So from an intermediate term perspective, we have no reason to be looking for the exits at this point. Certainly from a short-term perspective, some of the momentum and those types of readings are historically extended, but that doesn't mean anything as far as the potential for the longer term or the intermediate term. We think, obviously, from a technical perspective, you got the NASDAQ 100 and the Dow and some other averages bumping up against all-time highs. So maybe a short-term pullback or pause, especially with some of the short-term sentiment readings getting ramped up of late. But again, from an intermediate term perspective, our stuff is very strong, and we don't see any signs yet that we want to be looking for the exits.
Well, Dana, let's dive in a little bit more to the improving market breadth. You've made the point on our show a number of times that generally the markets will trend with the overall direction, 70-80% of the direction of the stock market. And if you think back earlier in the year, some of the rallies we saw in the first half of the year culminating in July were really led by the mega cap tech stocks and the tech sector, and it was holding up the weighted indexes. But we were talking before this call that if you look at the even weighted indexes, or if you look at something like the IWM, the Russell 2000, and look at the small caps, the participation has really broadened out. So maybe just dive under the hood on that area of the market breadth and what you're seeing.
Yeah, sure. That's exactly what I'm referring to when I'm talking about the broadening participation. And as you said, for a durable or persistent rally, you want to see that wide participation. And we don't get it when you have a narrow select group of large caps moving to new highs like we saw in July, June, July, even as the equal weight averages or the broader markets or the smaller cap averages are languishing or diverging to the downside. Those types of rallies are not persistent. They're not durable. Eventually, they will go the way, as you mentioned, of the broader market. So, and that's what happened at the top in July. As the S&P was hitting new highs, the micro caps, for example, were just off all or 52-week lows, which is not a good sign. And again, when that happens, almost 100% of the time, the market will correct towards the broad market, at least in the near term. That's what happened just recently into the lows in October. Now we saw, as I mentioned, it seems like a lot of the froth that was built up in July reversed itself in October. A lot of people started hedging, getting a little bit of fearful readings as far as investor sentiment. And those are the conditions that you need to spark a near-term bottom. And we saw a huge short covering rally right off the bat. Didn't see a great breadth or great participation that first month of the rally. But as I mentioned, over the last month or 5 weeks or so, we've seen a resurgence in terms of breadth, internals, the broader averages, the equal weight averages, and now they are arguably leading the way, at least over the last couple of weeks. So we're seeing new highs now for the year in, like you mentioned, the equal weight averages, mid caps hit new highs for the year. Even the small and micro caps challenging those highs from July. So that is a good sign. As I mentioned before, that's a sign of a potentially persistent rally.
So, Dana, some of the bears are pointing to a couple recent data points. One being last Friday, the biggest ETF inflows into SPY ever since its inception in 1993, as well as some fear-greed indexes reaching extreme greed. So the bears are pointing to these, saying that everyone's plowed into the bull side of this boat, and that, they're saying, is never a good sign. What do you take away from some of this data that truly is showing people are more bullish on these markets?
Yeah, and what's going to make people more bullish is price action, right? So price leads sentiment, and we've seen historic rally over the last couple months. So you're going to see that improvement in sentiment, and we've seen just of late some of those signs that you mentioned, those inflows in the ETFs, some very extremely low put to call ratios. So people are catching up as far as sentiment to the price action. So I would say from a durational standpoint, that's probably more of a short-term concern right now. As I mentioned before, at those October lows, people are extremely hedged and very defensive. Allocation has come down quite a bit. At this point, after the initial short covering rally, I think there was still a lot of cash on the sideline, at least tradable cash, and that's just starting to come in now. I don't think we're near to the extent that we were in the summer, so I think a lot of people are still underweight. Maybe we did have that rush of late, and like I mentioned, that could lead to a short-term pause or pullback like we saw yesterday, and especially as we're challenging those all-time highs in some of the major averages, it's a good spot for a pause or pullback. But I think allocations are probably still quite a bit below where they were in the middle of the summer. So that means more potential cash, more potential fuel to come into the market if we do get a dip. And that's another reason I think we do continue to see higher highs. And one reason I'm not that concerned in the intermediate term yet about the inflows and the sentiment readings getting higher. I think that's more of a short-term phenomenon, or a short-term concern at least.
Well, Dana, just to that point, when you think about different time frames, sure, maybe in the short term things have gotten a little frothy and there's a pullback, but you've noted before that the nature of the overall breadth and all of the different factors coming into a stronger market, that you can see some of these indicators stay overbought longer than people expect, and that actually in this kind of a thing, the overbought's actually a good thing of a strong market. So maybe just break down the differences between what we saw in July and why you kind of alluded to that, but how a strong market can just keep going, and it's likely that the dips will be more shallow than people expect as more money from the sideline tries to get in on any dip.
Yeah, sure. You're exactly right. Well, when people are overly hedged, or they have a very low allocation to stocks, which we saw in the latter part of October when we bottomed, the initial thing they're going to do into the rally is cover shorts. So that was the initial surge that we saw, but that still leaves them underweight, especially as stocks continue to rally, and that's really the telltale sign of an underweight condition in the market. Is a market that persistently rallies without any noticeable pullback, like we saw, over the last couple of months. It gave investors who are underweight pretty much no chance to get in. And again, that's not a bad sign. Yes, in the near term, you could get to the point where maybe we are about right now, where in the short term we're extended, we need a breather. But on the other side of the coin, that's just a sign that investors were very underweight and looking for any little dip in which to deploy some cash. And I think there's still more cash out there to deploy. So like you mentioned, I think any dips here will continue to get bought, and I think they should get bought. As far as momentum is concerned, that's the tricky thing about like stochastic type of indicators, and why some people get a little bit confused about it. Overbought readings aren't always a warning sign, especially when you're coming off of oversold signs. That first overbought sign could actually be a positive sign of momentum, and indicate further gains to come. Because typically when you see the end of the road, like we saw in the summer months, where it was kind of a grudging type of advance, and large caps had already been hitting highs for a while. By the end of that rally in July, you started seeing lower peaks in some of those stochastic readings, some of those momentum readings. And by that point, once you see some of those divergences, you see the higher highs in prices, but lower highs in the momentum types of statistics. That's when you start getting concerned. It's not that first surge off of the lows. That is often what we would call, a positive overbought type of a signal.
Very good point there, Dana. Let's also look at some other markets, because look, it's not just U.S. broad averages that are moving higher. There's a lot of markets that have moved up over the last couple months. Let's look at the bond market, because yields have been almost on a straight path lower. The 10-year was almost at 5% about 2 months ago, and well, now it dropped down to 3.8%. I know longer term, we've talked about it plenty of times, that you still see rates remaining higher, but what do you see in the bond market? And it seems like the rush into bonds as well.
Yeah, well, longer term, you're right. We do see yields trending higher for many years or decades to come, like we mentioned, like we've been mentioning. But the last few shows, we talked about dropping yields after they had broken out, I guess this summer, maybe in August. That maybe contributed to part of the pullback in equities, was the breakout in yields. But after we peaked, about the time it peaked in yields around the time that stocks bottom, we foresaw, and we've been talking about it, an impending test of that breakout level in yields in the 30-year and the 10-year yields. That would be quite the development as far as financial markets are concerned, because that, especially in the 10-year, that level around the 4% in the low fours, from a historical perspective, going back to even the highs in the early 80s, was a very significant level. If we could have broken out above that level on a sustainable basis, that opens up the next major up leg towards about 6.5% probably. So this test that's going on right now with yields pulling back and testing those breakout levels is really a monumental test. And if we can hold here, then we have substantial new highs to come as far as yields are concerned. And like I mentioned, the next big level would probably be about 6.5% on the 10-year. On the flip side, if yields break back below that breakout level, then we have a false breakout in the chart, and nothing, the only thing as strong as a breakout is a false breakout to the reverse side. So if we cannot hold these levels and we fall below, that opens substantial downside, which obviously would have a lot of ramifications across financial markets. And just from a yield perspective on the 10-year, for example, which is testing, around that 3.90 to 4% right now. It's a key level. If we cannot hold, then that opens up downside probably to, about 3.25, and eventually maybe like 275 to the downside. And like I said, that would have a huge ripple effect across financial markets, and might be a further boost to, at least in the near term, that rally that we're seeing in equities.
Well, Dana, another factor that's kind of gone in tandem with the interest rates pulling back is the U.S. dollar also pulling back. If you think back to last year, 2022, U.S. dollar had quite a move from the high 90s all the way up to 114.70. And then this year, there was that rally. It kind of double topped. A lot of people have pointed to around 106.70 to 107. That was in September and October, kind of when the markets were at their lows. Well, as the markets bounced up since October, the dollar has pulled back down and down and down. Now it's in the 101 range. What is your outlook on the greenback?
Yeah, right now, it's been range bound. It hasn't been like currency markets often, are some of the most trendy markets. It's been kind of a knee-jerk market. Not that you haven't seen a lot of higher highs, higher lows, pretty much going sideways. Right now, I would say the benefit of the doubt is now to the downside, with about that 99 level being kind of the downside target for us. That's kind of the must-hold level. If we break down below there, that opens up significant downside, I think, from there. So I'd keep an eye on basically around that 99 level on the dollar. Until then, we're pretty much just range bound. So nothing that would spark any aggressive positioning as far as we're concerned.
Okay, but watch that 99 level. Fair enough. That was the low so far of this year in July. Let's also talk about gold, because gold has done quite well, holding right in above that $2,000 level. It made another attempted run at around 2,100, quickly reversed from there. But again, this gold chart over the last couple months has been quite strong and is very close to all-time highs. What are you seeing for gold here, Dana?
Yeah, I see, basically a consolidation right now at all-time highs. As you know, we trade the ETFs and exchange-traded products as far as gold is concerned. So you're looking at GLD, for example, pretty much consolidating right around those highs we've seen over the last couple of years. And then you backtrack to 2011, and you got the highs in the same area. So if you're a charting patternist, looks like some variation of a cup and handle, and that's a very strong chart pattern. It suggests an eventual breakout, and it suggests plenty of upside once it does break out. So I think the last few years have just been kind of digesting that rally we saw off the 2016 lows, and storing up fuel for a potential more sustainable breakout once it does move above those all-time highs, which you don't want to ever anticipate a breakout, but the longer we hang around these levels, the more likely I think a breakout will be. So that's what, if we're betting, and we are with our position, we've been long, we would anticipate a breakout and more of a pretty healthy and sustainable next up leg.
Dana, just a quick follow-up regarding the gold market here. With that positive outlook for gold, I'm curious to hear what you think of the gold stock, something like GDX, that ETF, where it's broadly still kind of in the middle of a trading range that it's been in through 2022 and then in through this year. trading in a tighter range, but it too has rebounded over the last about 2 months, but it's not really close to all-time highs. So what are you seeing in the GDX chart?
Yeah, again, and that highlights the difference between the metal, the commodity itself, and the miners, the stocks, which GDX and the miners, they're going to be influenced by the metal itself and then also by whatever the stock market's doing. So you have to kind of weigh those factors out as far as analyzing the miners charts. Right now, I would say with our optimistic view on gold, that should lift the miners for sure. At least they should trend in the same direction as gold, even if they don't go to all-time highs like gold appears to be setting up for. As long as it's trending in the right direction, you could have a nice bounce, for example, in GDX back to the highs, those COVID highs from a couple of years ago, and you're looking at a pretty good return right there, even if we don't go to all-time highs. And then, if we do, that's obviously a long way to go. That'd be basically doubling right now from where we are. But I think as long as we continue to trend in the right direction, I think that is, especially to get a breakout in gold, which from a price perspective could be very profitable. You could get a little bit more juice from the gold equities, even if they don't go to all-time highs, even if they move up towards those highs from 2020, that gives you a little bit more juice than you might get in gold itself. Obviously, again, it depends what the equity market is doing as well, but as long as it's trending in the same direction, you might get, like I said, a little bit more juice out of the gold equities.
Well, Dana, I know that you mentioned you don't have a lot of thoughts on the energy sector, but I do value your technical look at it. When you look at the oil markets, it's been in a real whipsaw. Which way do you think the propensity of odds are as far as the future for oil as we move into 2024?
Yeah, crude's kind of been like, for some reason, it kind of looks like the dollar chart. We had that spike last year, and since there had a strong pullback. Since then, we've basically been range bound, I would say. We're near the lows of the year, which if we do hold that should provide some support right now. But I would say the benefit of the doubt right now for us would be to the downside. And if we do break the lows earlier in the year, that obviously opens up another down leg there. So, but again, being range bound, we don't have a strong opinion as far as taking any aggressive positioning in the crude market. I would say in terms of equities, energy equities, if you're looking for maybe to make an allocation somewhere that is not extended in the equity market, somewhere that is still in a overall uptrend and has pulled back and offering some entry points, I would say look in the energy space. We do have overall over the last few years, we're still seeing those higher highs, higher lows, still have plenty of upside to go. And we have pulled back to some decent support levels right now. So if you're looking to like I said, allocate some funds in the equity market somewhere that is not overly extended right now, that might be a spot.
All right, that's going to wrap up this weekend show. I hope everybody who celebrates Christmas has a very Merry Christmas, a Happy Holidays to everybody. We will be back next week with a few daily editorials, but it'll definitely be a slower week, as I think it's good for everybody to take a little time away from the markets and try to reassess as we head into 2024. That seems like it will be a very interesting year with now the change in central bank policies and this more optimistic outlook, especially for markets heading into the new year. Dana, thank you so much for all your time throughout the year. I greatly appreciate your insights on the market and reading over all your content over at the Lyons Share Pro website. We will chat again in the new year. I hope you have a very happy new year, and thank you again for taking time on this weekend show.
Thanks, Corey. Thanks, Shad. I appreciate it. Merry Christmas. Happy New Year to both of you and to all the listeners out there. Appreciate being on.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.